we do try and think about what the impact is going to be on our portfolio and how we can hedge against that.
Hedge as an asset class has some of the best talent density of fund managers in the country.
I think gold has had thousands of years of history where people see value in that. It's got a little bit more utility in terms of jewelry use cases. Central banks store that. I don't think central banks have started to store Bitcoin yet.
Please send through any questions you might have. I've obviously got a couple of backups just in case we're slow off the mark here. But I'm going to start with Jazz. Maybe just in times like this when you are dealing with, so the Iranian situation, you're dealing with things that are moving very quickly, changing every day. How do you guys as a team kind of navigate this and stay on top of it?
Look, it's all hands on deck. I'm quite anxious being here because I'd much rather be in the office having these debates with the guys and all the rest of it, because it is such a dynamic and fluid situation. It's changing literally on an hourly basis. Last night you get a message that the US energy minister is effectively telling you that they've escorted a ship straight through the Strait of Hormuz with the US military's assistance, and then 10 seconds later he retracts that and oil prices are spiking. So I think it's very, very difficult. But I think you have to try and keep your heads in these scenarios, and I think like Dave is a fantastic calming force in these sort of events. But we do try and think about what the impact is going to be on our portfolio and how we can hedge against that. So at the moment we do have that put option insurance that we referred to a little bit earlier that provides protection on sort of 15 to 20% of the portfolio exposure. You sit on a component of cash, which is probably another 15%. And then, you have these discussions about, do you potentially buy oil futures as a hedge because you think it might be a reasonable expectation that if it's a protracted conflict, you are going to see a much higher oil price. So I think we're always looking for ways to hedge that exposure and make sure you miss those 10 worst days that Al was referring to in his slide deck. So it's extremely dynamic, but I think you've got to also stay true to those core themes that we have and understand how each of those various buckets is going to be impacted in this scenario.
And then maybe, equally as important is, when do you think about engaging risk in a time like this, right? So, you obviously cannot wait until war's over, everything's back to normal, because prices will have moved. So you've got this protection, it certainly helps, but how then do you consider actively actually engaging the market, taking positions when at that point of maximum pain, when you don't necessarily know it is the point of maximum pain at that time?
Well, generally when you feel like throwing up, you should do the opposite of what you think. So that's when you start trying to engage, and it's do the opposite of what you're feeling at these points in time, but with special attention paid to the valuations of the businesses we're looking to deploy capital into. So I think you'll have the protection offered by all of those instruments, as well as potentially the gold side of things at this point in time. But then as the market comes your way, I think you do have to sort of redeploy some of the proceeds from your sales on the put options and gold and whatever it might be into companies that represent fantastic value. So at this stage, we're still very, very optimistic, particularly on the AI side about valuations over there. They've been really under pressure for the last sort of 6 months or so, and I think the fundamental outlook for growth is looking even better for those companies. So we're quite full up over there, but then selectively, where South Africa does come under substantial pressure, we do have capacity to deploy.
Cool. And then, maybe just in terms of the store of value thesis that you're talking about, obviously owning gold, etc., is the feeling there that kind of US hegemony has fallen away to some degree, and the belief that the dollar is all powerful, that owning risk-free assets being US treasuries from a government perspective, i.e. other governments, not the states, has changed, and has changed for good? Obviously forever is too long a time period, but certainly for the foreseeable future, is that part of the thesis, is to say that if this thing isn't the reserve currency of the world, what will be?
Well, I think if you just look at the relative growth rates between the US and China, I think the US is ticking along at, again, 1 to 2%. We think that accelerates because of AI. But on the Chinese side, they've been growing at 5 to 8% for the last sort of 2-3 decades, and even higher rates in those earlier years. So I think as they get bigger and more influential, you're going to get to a point where they command a greater share of the global economy, and their status improves. That is putting the US status as this hegemonic power under significant threat at this point in time. And the other thing that's shooting the Yanks in the foot at this point in time is this debt balance. And it is an enormous number, and they're still running at a budget deficit of close to 7% of GDP. So it doesn't make a hell of a lot of sense. Their debt bill is getting bigger and bigger and bigger, and at some point, just with us in our personal lives, you have to find a way of funding it. The only way, the government has the luxury, like we do not have, of printing money in order to fund these things. So I think over time, that is exactly what the US system has done. And I think a couple of years ago, that is the major thing coming out of COVID that created the inflation that we saw in the market. It wasn't the supply-demand shortages. It was the fact that these governments just ended up printing tons and tons of money, which, relative to the amount of goods in supply, made things a hell of a lot more expensive for the average person on the street. And it's a lot easier to print money than to increase tax rates from a government perspective. So I think all these things are just sort of adding up to a scenario where you really want to be exposed to assets that retain their value. And I think gold and PGMs is one category of that, but then high quality equities where you own companies that have extreme pricing power and can capture some of that inflation is a fantastic place to be as well.
A quick question here. Is your hedging strategy limited to equities and commodities, or does it extend to bonds and property? So maybe just holistically, how do you guys think about hedging?
We were having a debate about a week ago about credit spreads in the US on high it is investment grade credit, and the extent to which you are going to potentially see pressure on this private equity market, which has been funded in the US by institutions that are non-bank institutions, but it's software companies, for example, that have been traditionally quite stable, but they've now taken these companies private and levered them up massively. Now, all of a sudden, with AI threatening software as a category, does that put those cash flows under pressure? So that is a category we've been looking at this point in time. We haven't executed on that just yet because we haven't got accounts open with certain things. But we're looking in all sorts of categories where we think it potentially makes sense. The most common thing that we have done in the past has been the use of put options within the equity space, with more of a leaning towards the US because it is big and liquid and those instruments are listed. So it's a lot easier to execute that at scale in a very short space of time if you are able to see sort of risk before everybody else, and where the price of that insurance is particularly low. Because again, you cannot pay an unreasonable price for insurance, because I think that's just throwing good money after bad. And we are already looking for scenarios where you have the ability to buy insurance in an environment where the cost of that insurance is extremely low and the payoff is going to be very high.
Then another question, just maybe around pair trading strategies and how you guys think about pairs generally in the portfolios.
Yeah, pairs is very important. Say, for example, in the South African retail space at this point in time, we're not that bullish about the prospect for the South African consumer. But if you look at the underlying results of a ShopRite relative to Pick n Pay and Spar, ShopRite continues to perform extremely well. They've got a massive economies of scale advantage, and you have a situation with 60/60. If you just think conceptually about how they operate that business, everything is integrated because all of their stores are owned by the stores. They know where their inventory is. Every piece of cheese, every carton of milk, they know where it is at any given point in time, so they can service your 60/60 customers out of the stores and the depots, given the fact that they've got this information available and at their fingertips. If you think about a Spar, for example, they're very much more diversified because it's a franchise operation. Even if they wanted to go into this category like 60/60, they just couldn't do it because every one of your franchisees will have a different operating system, and you will not know where that piece of cheese is at any given point in time. So they're at a structural disadvantage relative to a ShopRite, and And those are fantastic opportunities for us where we can buy these businesses like a ShopRite on a moderate valuation, and you can short sell SPAR against that because you've got these potential headwinds for one and tailwinds for another, which is it's two sides of the same coin, but one will be much better positioned than the other. Those are fantastic opportunities to take advantage of if you can get the timing right and the valuations are supportive. Equally in the property space, we're still quite bullish on the growth prospects for a business like Resilient, and less so on a growth point, for example. So we can take advantage of those sorts of pairs. But the pairs, I think, would say you're either looking to take advantage of a big dislocation in valuations, or where the growth prospects of those businesses are materially different relative to each other, and that allows you to put risk on the table without adding any net exposure or portfolio beta, and hopefully you make decent returns out of that spread going forward. I mean, another thing that we've done with quite success, which is not pair trading per se, but is very, very similar in terms of the construct, is something called rump trades. So rump trade, a great example of this a few years ago would be Fortress, the property company. We ended up buying, I think it was 10 or 12% of the business at that point in time, but they've got this massive investment in Nepi Rockcastle. If you just sort of take a basic equation and you said, well, take Fortress, less their investment in Nepi Rockcastle, what is the balance of the portfolio worth? And at that point in time, I think you were sitting on a portfolio value of close to 15 billion, but the implied market value was only 2 or 3 billion. So by putting those sort of trades on, we were able to buy Fortress or go long on Fortress, and we could go short Nepi Rockcastle to just eliminate the exposure within the construct, and then you're buying their local portfolio at a deeply discounted price. And that has now got to a point where that local portfolio is trading close to book value, and we've exited the trade. But those rump opportunities, I think, are very much our bread and butter, and we look out for those things every day.
Then just a quick question on your gold exposure. I mean, you obviously talked about Pan-African. Do you have any views on kind of taking a position in the underlying commodity, or is your preference for the equities?
Preferences for the equities. I think the benefit that you get from owning the company is that you get operating leverage on their cost base. So in essence, as the gold price goes up, they've got a fixed cost base, and the impact of your growth in earnings is going to be substantially higher than what the impact on the gold price is going to be. So, I mean, it comes with sort of puts and takes, because it also goes the opposite way. If the gold price doesn't go in your favor, you can have operating deleverage, and the growth rate is going to be substantially lower. But for as long as you have that positive view on gold, you want to sort of get the maximum leverage possible out of that trade. We do actually short gold against the gold companies to try and manage the see-through gold exposure at any given point in time, particularly in these environments where Pan is lagged for the past week, for example. We will buy more Pan shares and then potentially look to short out some of the gold price at the same time, just to capture that operating leverage. So it's fairly dynamic, but we do mostly prefer the underlying gold companies as opposed to the gold itself.
There's a question here which I'll actually answer for you guys, because it is, I mean, I might rage a little bit, but why not? Please comment on why Regulation 28 limits a hedge fund when looking from this presentation. That would be a wise addition for careful long-term planning. Totally agree with you. Thank you, sir. But it is, I mean, it is a frustration for us, obviously, I think, and the issues come in that from a Reg 28 perspective, hedge funds were deemed to be, or are deemed to be, a separate asset class. Fine, no issue with that. But that asset class limitation is at 10%. And then the second element, or the second part of that, which is, to me, the frustrating part here, is to say each individual fund manager you can have a maximum allocation of 2.5% in a Reg 28 portfolio to an underlying fund. I mean, I suppose, and to the FSCA's credit here, they regulated hedge funds truthfully before almost any other market in the world. So they were proactive in that space, and I mean, it has certainly allowed us to be more confident, or certainly has allowed your investors to be more confident that hedge funds are a regulated asset class. It's not, it's not something that's unregulated, and I think there's a huge benefit to that. So I'm not saying that all of this is bad. I do think Reg 28 should be amended. Do I think that's going to happen anytime soon? Sadly, I don't. I think because hedge funds are a relatively small part of the sector, if you think of kind of the lobby groups who are trying to position issues around, with the FSCA to look at, I do think there's, just to clarify, this is a whoop, and that's a, sorry, I see the two guys looking going, he's got two watches, what a dick. This is just to check, this is to make sure that my sleep score is cool. Okay, thank you. But I do think, so I mean, I think the answer is it is going to be here for the foreseeable future in terms of Reg 28. What I would say to you, however, is that 10% allocation is a meaningful, or is a decent allocation, and I would, I mean, I'm doing my competitors' work here for them, but I do think that there are some very, very good hedge fund managers in South Africa. In fact, I would say to you that I think hedge as an asset class has some of the best talent density of fund managers in the country. Like, there are guys that have been doing this for a really long time and they're very good at it. So you can, without doubt, find 4 quality hedge funds to build up that 10% portfolio for you. Obviously, if you go into a fund of funds, that can get up to 5%. So there's definitely a means of being able to get relatively decent exposure. I mean, I certainly think that number should be higher, but I am obviously talking my own book here. But I do think it's a worthwhile exercise to do if you haven't done it, to actually get them into retirement portfolios. And then obviously in the living annuity space, there is no limitation. So, and I think truthfully in living annuities is often where hedge can play a very meaningful role because of that smoothing. So the sequence risk obviously is reduced, et cetera, et cetera. So I do think it is something that can be considered quite meaningfully there. Anyways, my rant is over. Thank you very much for listening to me. But moving on to the next thing, how do you manage currency volatility to achieve rand returns and consistent rand returns?
So we're not currency traders. It's particularly difficult. I think over the course of the last 12 to 18 months, we have been running much higher see-through rand exposure. So what we do is at a portfolio level, every instrument will sort of classify and determine the sort of rand and dollar and other currency earnings exposure, and we bring it all up at a portfolio level, and then through currency futures, we will manage that effective exposure. So for the better part of the last 14 years I've been at the business, we've had a range of between 25 and 35% on high growth and exposure to non-rand assets. Everything else has been hedged back to rands. And over the last 12 months or so, we've been running a much higher sort of rand see-through exposure that is closer to 80% rand and 20% non-rand, and most of that has been because of what we saw here with this massive trade surplus as a result of the PGM and the gold sort of rally, which is really supporting the South African fiscal perspective, and there's just so many more dollars flowing into rands. There's huge demand for rands. So we do sort of manage that fairly dynamically, but it doesn't really change from time to time. The exposure at the moment, that 80% rand, is higher than it has been over quite a few years. But we manage that all at a portfolio level, and changes are fairly infrequent.
Then a macro question, just kind of what, obviously it's dynamic. Obviously everything's changing in Iran quite rapidly, but what's your current kind of best case, worst case, and maybe some probability allocation? I'm putting you on the spot here, but some probability allocation to those two things.
I wish I knew. I think we were chatting a little bit earlier, but there's probably about 20 million barrels a day of oil that should go through the Straits. It's about 20% of global supply. 3% of that's from Iran. The balance is from all of the other sort of Gulf states in the region. The Saudis yesterday have mentioned a pipeline that they've got where they effectively transport the oil to the western side, get onto ships, and then that obviously comes around the Cape of Good Hope or wherever they're selling to. But the incremental sales that will go through that pipeline is approximately 5 million barrels, which is going to be like 25% of that whole. We do also see quite a few ships that are going through that are Russian and Chinese that are going directly to Iran to go and pick up some of that oil from Iran. So if that's 3% of global supply, it is a decent chunk of the number out of the region. So yeah, it could be as much as 10 of the 20% that is potentially solved for. But taking 10% supply out the market is a real issue. There's downstream implications in terms of like South Africa, for example, where we have a lot of crude in these 8 million barrels of stockpiles that we've got, but that's not refined capacity. So that still needs to go to the refinery. You need to go and turn that into petrol and diesel and all the rest of it. So I think that is a bit of a challenge from a local perspective. It really comes down to what the duration of this war is likely to be. Donald tells you it's going to be 3 to 4 weeks, and then they're out of there, and it's going substantially better than what they anticipated. And the Iranian side is saying they're sort of hunkering down for a much longer and protracted battle. I think the difficult thing is it's very easy to start a war, but knowing when these wars actually end or how they end and how your partners, such as the Israelis, are sort of aligned with your objectives, I think those things are all very, very difficult to tell. So I think we've got as good as a view today as many of you probably have on the ground, and we're just looking for ways to buy cheap protection while at the same point expressing our positive views on all of these different buckets, such as AI, where we're expecting significant acceleration in growth rates in the coming year, in store of value assets, where I think, again, this war does help those specific categories of assets. And then in South Africa, how do you manage the SA exposure where you're going to have potentially a little bit more sort of headwind relative to tailwind if it protracts or goes on for longer? So best case is in 2-3 weeks' time, we wake up, the US has gone home. They've really dismantled the offensive capabilities of the Iranians, and everything sort of goes back to normal in the Strait. Worst case is that, like we saw yesterday, there's potentially mines in the water that the Iranians are putting out there, which could strike tankers and sink ships, and that I think is quite a scary prospect. But we do think it's limited to that sort of 10 of the 20 million barrels or 10 of the 20% that we think is exposed. So hopefully it's not all fall down, but it is a significant risk at this point in time.
Okay, then I'm going to give you one final question here, just to put you on the spot again. But could you please elaborate on why you said Bitcoin is magic bean money?
There's huge debates internally in the office. Jacques is quite pro on the whole Bitcoin thing as a store of value asset. I'm a little bit more reticent. I think gold has had thousands of years of history where people see value in that. It's got a little bit more utility in terms of jewelry use cases. Central banks store that. I don't think central banks have started to store Bitcoin yet. So in terms of incremental buyers and long-term holders, I don't really see those existing. There's also potential risk around quantum computing, where apparently the encryption methodology on Bitcoin can potentially be cracked as quantum sort of comes into play in the next couple of years. So it's just a little bit more uncertain at this point in time as a digital asset, where gold is something that is, you can take your bar and you can go put it into a nuclear bunker on your farm with your guns, and it's just a relative preference in terms of one versus the other. I have read a very interesting book called The Sovereign Individual, written about 20 years ago, and specifically refers to a digital currency that will emerge over time, where you have limited supply and all the rest of it. And I think it was very much ahead of its time at that point in time. But if, in essence, the summary is that governments are going to lose legitimacy. They're going to try and tax their constituents more and more over time. But capital is going to become a hell of a lot more sort of flexible in terms of where it can go to. And it'll go to regions where the tax burden is least cumbersome, and that is where it sees this digital currency sort of playing a role. So it's a bit of a long roundabout way of saying, like, it has a place, it's just very difficult for me to forecast like what it's worth, gold is equally difficult, but it has been around for like 2,000 or 3,000 years. So,
Okay, I'm going to leave it there first. Thank you, Justin.